Welcome everyone. In this session, we are going to learn about candlestick patterns. There are different types of candlestick patterns which we are going to learn in this whole course. Let's have a look on what are those patterns which we are going to learn in this course. Hammer pattern, spinning top, bullish engulfing, bearish engulfing, doji, Marubozu candlestick pattern, shooting star, hanging man, spinning top, morning star, and last one evening star. On this candle pattern, we are going to learn in the whole course, and I will be teaching you the strategy what we have to follow for trading each of this candlestick pattern. How we have to enter, how we have to exit, what should be our stop loss, what should be our target level, everything I will be teaching you in this course. So let's start with our first candlestick pattern, which is hammer. Hammer pattern basically formed at the end of a downtrend. See here, market here, as you can clearly see, market is falling, and then a pattern is being formed at the bottom of downtrend. This type of candlestick is known as hammer. Hammer candle. Hammer candle have a long wick with a short body. Hammer candle have a long wick with a short body. This long wick basically shows the rejection, which means since price is falling down from the top level, but at the end what happens, price further tried to fall down till this level, but at the end bulls overpowered. bulls overpowered bulls overpowered, which means instead of closing the candle over here, bulls overpowered and pushed the price up to this level. Price opened here in this level, made a low of this level, and when it touched the low, bulls overpowered and pushed the price up to this level. And as you can clearly see, closing price of this candle is equal to its high price, which means now the bulls have dominated and the bear run is being over. That is how a psychology of hammer pattern is. The basic psychology behind this pattern is the market was falling down, price opened somewhere here, made low of somewhere here, but failed to close at this level near its low. It failed to close near its low. Instead, what happened? Bulls took the charge and pushed the price upward and made it close near the high. Thus, the color of this candle is green, and this pattern developed is called hammer pattern. And since it's showing rejection from lower level, which means the price is not going to fall further. This is how the hammer pattern is being interpreted. This is how the hammer pattern is being interpreted. I hope you might have understood the psychology behind the hammer pattern, its formation and its interpretation. Now let's have a look how we can trade using this pattern. See, this is a Nifty 50 index 5-minute chart. One more thing I would like to tell you, always try to use candlestick pattern in a time frame of 15 minutes or more. Don't use for intraday trading in a time frame of less than 15 minutes, because most of the time when we go in a time frame below 15 minutes for candlestick pattern based trading, we get trapped, because higher the time frame, higher is the accuracy. Higher the time frame, higher is the accuracy. High time frame, high accuracy. If you are using 1 day time frame, then you will be having more accuracy. If you are using 30 minutes time frame, you will be having somewhat less accuracy, but it will be good enough. And if you are using 15-minute time frame, it is also good enough for intraday trading. But if you are using 5 minutes time frame, then accuracy is bit less, that is about 45 to 50%. But whereas in 15 minutes time frame, you get an accuracy of around 60 to 70%. In higher time frame, you get around 70 to 75% of accuracy. That is why I say never use in 5 minutes time frame for intraday trading. Instead, you can use it in 15 minutes time frame, 15 minutes time frame and 30 minutes time frame for intraday trading. I have used your 5 minutes time frame for just explaining you how pattern works, but remember you have to trade in 15 minutes time frame and above only. See what happened here. Market fell, and at the end a hammer is being formed, which means, as you can clearly see, price opened somewhere here, made a low of this, bull overpowered, and finally closed somewhere here. Basically, a hammer can be either of red color or maybe of green color. But main thing which we have to look is it should have a long wick and short body. Color doesn't matter. Previous trend and long wick and short body matters. Since as we can see here, the market was in downtrend because market was falling continuously. What happened over here, a candlestick of red color with long wick and shorter body formed. So this is a hammer. Now how we have to trade this pattern? What we have to do is we have to enter at the high of this candle, keeping stop loss at the low of this candle by giving some buffer of 1 to 2 points. This should be the stop loss, this should be the entry, and target should be minimum 1 is to 1.5. Risk reward should be minimum 1 is to 1.5. If you are not getting a risk reward of 1 is to 1.5, then you should avoid that trade. You should never trade with a risk reward less than 1 is to 1.5. Always trade with a minimum risk reward of 1 is to 1.5, and maximum you can trade it up to the level what you want. But minimum risk reward should be 1 is to 1.5. So what you have to do is, here your entry will trigger, this would be your stop loss. Since this much is our risk, our reward would be 1.5 times of this, which is somewhat this. You would have achieved your target over here. This is how hammer pattern is being traded. Similarly, as you can see here, this one is also a hammer. Entry over here, stop loss somewhere here, and since this is the risk, this should be your reward, and you would have got a risk reward of 1 is to 1.5 over here. This is how you have to make your entry and exit in candlestick pattern. Let's look into the another example. This is the chart of USD INR daily time frame. Here you can see, since the market was falling, we can clearly see a downtrend here, and at the bottom somewhere here a hammer is being formed with a long wick and short body. As you can clearly see, here the body is short and the wick is long and formed in the downtrend. So what we have to do is, we will be entering at the high of this candle. This would be our entry, keeping a stop loss by giving small buffer. This would be our stop loss, and since this much is our risk, our reward would be minimum 1 is to 1.5. So 1.5 reward would have been achieved somewhere here. This is how we have to trade using hammer pattern. What things which we have to look before trading is previous trend. Previous trend should be down and the candle should have long wick with short body. Three criteria for trading with hammer pattern is previous downtrend, second long wick, third short body. If these three criteria is fulfilled, then we can enter with a risk reward of minimum 1 is to 1.5. This is how you have to trade using hammer pattern. Let's see some other examples. Here is the chart of Tata Motors, 15 minutes time frame, NSE listed. Now see, clear downtrend, market was falling, back to back red candles 1 2 3 4, and at the bottom long wick, along with short body, that is hammer candle has been formed. So now, as per our strategy, what we have to do is, we just have to enter at the high, keeping our stop loss just below the low of this candle by giving some buffer of 50 paise or 1 rupees somewhere here. This would be our stop loss, this would be our entry, and our target would be somewhat here. If this is our risk, this will be our 1.5 risk reward. So here you might have achieved your target somewhere in this zone. So this is how you have to trade hammer pattern. But always remember, as I have said, the shortest time frame which you can use for trading using candlestick pattern is 15 minutes. You should never trade below this time frame. Always use time frame for intraday as a 15 minutes or 30 minutes, and for positional you can go for 1 hour, 4 hour or 1 day time frame. This is how you have to trade. Let's look into another example. See, State Bank of India, 15 minutes time frame, NSE listed, clear downtrend in here, small consolidation, and then a hammer pattern formed, short body, long wick. So what we have to do is entry at the high, keeping the stop loss by giving some buffer. This is our entry. So our target would have been achieved in the next candle itself. 1 is to 1.5 risk reward. This is how you have to trade. This is actually a strategy what you have to do and plan accordingly. Now here we have the example of Adani Ports and Economic Zone. As you can see, our three criteria: first one, downtrend; second one, long wick, and the third one sh- short body. On this criteria are being fulfilled by this candle, which is a hammer. As you can see, previously Adani Ports and SEZ was in a downtrend, and then a hammer pattern has been formed at the bottom of the trend. So what we have to do is just we have to act according our plan and strategy. Our entry point will be the high of this candle, stop loss, this is entry. Stop loss will be the low of candle and giving some buffer of 1 or 1.5 points, and our target will be just 1.5 times of the risk. So almost this much would be our target. So as you can see, we would have achieved our target in this candle. So what we have to do is we just have to maintain our risk reward ratio of 1:1.5. If our RR ratio is not getting fitted in this proportion, then we have to avoid that trade. So I hope now you might have got some clarity about this pattern and how we have to implement our strategy and trade according to the hammer pattern. Let's look into one more example. Bharti Airtel Limited. It's a 15 minutes time frame NSE listed. As you can see, a small downtrend followed by a small correction, again downtrend, correction, and then again a downtrend. So we can say that the stock is in downtrend. At the bottom of downtrend, you can see a short body, long wick candle is being formed, which simply looks like a hammer. So what our strategy says, we have to enter at the high of this candle, keeping our stop loss somewhere here. So this is our risk, 1.5 times reward, which will be somewhat this, and as you can see, we would have achieved our target somewhere here. And as you can see, there is one more hammer formed just after our entry candle. So this gives an additional confirmation that we have took the right trade. So this is how you have to interpret the patterns which are being formed on the chart in live market, and you have to plan your trades and you have to act accordingly. What things you have to keep in mind for using this technique is the three criteria which I have told you. These criteria are golden rule for trading in hammer pattern. First one is, as I said, previous downtrend. Second one, candle with long wick. Third one, candle with short body. When these three criteria get fulfilled, we just have to make our entry at the high of the candle, keeping our stop loss at the low of candle, giving 1 or 1.5 points of buffer, and keeping our target of just 1.5 times of what we have taken the risk. So this is how you have to trade the hammer pattern. Now I hope you have got complete clarity about the hammer pattern and how we have to trade. I hope you might have also understood about the psychology behind this pattern and why we trade hammer pattern like this. So this is all about the hammer pattern. We will be looking into the further candlestick patterns in our upcoming session. So till then, all the best for your trading career, and see you soon in the next session.